Yeah, we're seeing a trend and a real opportunity with rental homes. Um, so we own quite a few homes that we rent out. And an interesting thing that we've learned is we have apartments and we also have homes. And this is not a blanket statement, but generally speaking, we find if they're renting an apartment, they eventually want to own a home. If they're renting a home, they want to be a renter. They don't want, they want the flexibility of move quickly. They don't want to have to worry about when the furnace breaks, how are they going to fix it? They're looking for a convenient lifestyle. And so we really love the rental home aspect because those renters generally really treat the home like it's their own. They just don't want to have to hassle when the furnace does break down, when these types of things, and they need to have some flexibility and they want conveniences. And so we're really high on that market right now of building more and more homes that we're turning into rentals.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dale Wills. Dale is an experienced real estate developer who has been involved in the industry for more than 25 years. He is the owner and founder of Centra Companies, and since 2011, he's overseen the development of more than 1,500 homes across 50 projects. And in just a minute, we're going to speak with Dale about the investment opportunity in single-family homes. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Dale Wills. Welcome to CREPN Radio.
Darren, thanks for having me. I'm looking forward to our conversation.
Well, likewise, I'm looking forward to it. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I've been involved in, with the exception of a short period of time, in real estate in some form. Worked in banking for a period of time doing construction, development, mortgage lending. I've owned my own home building companies. I worked for a company where we built a city from scratch. We had to create our own sewer infrastructure and water and design the city. And then most recently, since 2011, started Centra Companies. We originated, our focus was working on bank owned properties that they had foreclosed on and didn't know what to do with. So we worked through a lot of banks, ended up in some cases just buying a lot of assets that we worked on and repositioned. And today we do a little bit with apartments, value add opportunities with apartments. We have a home building company that we do 120, 150 for sale houses a year. We're doing a little bit with build for rent, meaning single family homes that will take an entire subdivision and turn them into rental homes. And then just this year, we started a new adventure, Central Capital Partners, which we're allowing people to co-invest in those projects alongside of us.
Awesome. So you've got quite the kind of the variety there that you work in, and I'm looking forward to talking with you about that. And for our listeners, where, or you mentioned to me earlier, you're in the Midwest in Minnesota, is that right?
Yep, Minneapolis. Yep.
Okay. And is that primarily the area that you focus on?
That's where the vast majority of our business is. We are looking at opportunities in various parts of the country as we expand our footprint. real estate's real estate. You need to understand the local market, but there's great opportunities all over. So we're looking forward to doing some expansion here soon.
Got it. So let's talk a little bit about the single family aspect of your business. You mentioned in 2011 you guys started with acquiring some of the bank-owned properties. Were those primarily like a reposition and sell, or did you create a rental portfolio, or what did you do with those?
It was a little bit of everything. We ended up starting to work with one bank that had asked us to come in and help them out. And they had raw land they didn't know what to do with. They had land that was partially developed and abandoned. They had lots that were finished. They had commercial pads that were finished. They had commercial buildings that were partially completed, houses that were partially completed, and they just didn't know. And so they partnered up with us to find a solution for all of those. And so if it was a partially finished development, we would go in and finish it out. Partially finished homes, we finished them. Partially finished commercial space, we finished them. And in most cases back then, hindsight's 2020. I wish we would have kept a whole lot of that as rentals. But back then, most of it we would reposition and then find a buyer for the end use.
Got it. So the partially built or fully built, it sounds like more of it was like a developer type loans that failed. Is that
Yeah, builders
okay?
or developers that had failed at the loans and the banks took them back.
Okay. So still kind of a new construction
Yeah,
product.
yeah. We didn't deal with anything that was old. It's all stuff that was partially done, and they just didn't know how to get it to the finish line.
Got it. Got it. And so now you guys have kind of multiple um, silos or focus points. You mentioned the single family development. You mentioned some multifamily value add, which I assume is acquiring an existing property and then improving that.
That's
And
correct.
then
Yep.
and then I thought I heard you talk about some rent to own or some sort of like a development for with rentals.
Yeah, we're
Uh,
seeing a trend and a real opportunity with rental homes. So we own quite a few homes that we rent out. And an interesting thing that we've learned is we have apartments and we also have homes. And this is not a blanket statement, but generally speaking, we find if they're renting an apartment, they eventually want to own a home. If they're renting a home, they want to be a renter. They don't want, they want the flexibility of move quickly. They don't want to have to worry about when the furnace breaks, how are they going to fix it? They're looking for a convenient lifestyle. And so we really love the rental home aspect because those renters generally really treat the home like it's their own. They just don't want to have to hassle when the furnace does break down, when these types of things, and they need to have some flexibility and they want conveniences. And so we're really high on that market right now of building more and more homes that we're turning into rentals.
so in that, are you focusing on like infill lots or are you guys doing a whole development of this type of product?
The intent is to do it by development. Um, we've found that most people, and again, this is not a blanket statement, but generally speaking, a lot of the people that are renting homes in part are doing that for convenience. And so you want to be closer into the core because the further out you are, the less conveniences. They want the conveniences of shopping, conveniences of restaurants, conveniences of entertainment. And the further you go out, if you get into third and fourth and fifth tier um, communities, then they don't have those conveniences. So, the further we get out, we generally will focus on for sale housing. The closer we get in, that's where it really does make sense if they've got all those conveniences that they're looking for.
So speaking about the conveniences, are there any things that you build into the community and also if you could give kind of a size range on some of the communities for the rental housing?
Yeah, I've got a good friend who does this, and he does communities that are anywhere from 60 to 200 units, and they highly amenitize them, and it's worked well for them. They'll put in clubhouses, they'll put in community pools, they'll put in pickleball courts, tennis courts, basketball courts, and it's worked really well for them, and it's been a great business model. They made a lot of money. In those cases, they're pushing rents. They're looking at the higher end. They're looking at, I think he said their average renter makes 163,000 a year. And so it's a higher end product. And it's been immensely successful for him. Our focus currently is more on value. And so for us, we don't do the amenities. That doesn't mean it can't work. That's the example of my friend. But ours is we don't do the clubhouses, we don't do the basketball courts, we don't. It's more of we're focused on. I'd like to have a yard for my dog. I'd like to have a yard for my kids. I'd like to have the convenience of I get out of my car in the garage and I'm in the kitchen to put groceries away. And I still need to be cost conscious. I make 80,000, 90,000 a year. And so I can't afford those amenities. So that's been more of our focus. And we generally don't like doing much of anything under 20 units. That's 20 and more. From a logistics standpoint, I can build and develop 100 lots with the same amount of effort I can do 10 lots. And so for us, it makes, we're at a point in the maturity of our company that we can do larger deals. And so we try to do larger and generally shy away from anything less than 20 units.
And are all of these single family, or is there any attached type housing?
Yeah, we do attached as well, townhomes. What we have found, even those renters, ideally, you've got a backyard that's fenced in. So it may be a backyard that's 10 by 10, but those renters, having dogs is really a big deal for renters. A high percentage of them have a dog. They want to be able to get home from work, let that dog out in the yard, but not have to watch it. And so what we've learned with townhomes, a lot of times in your townhomes, you don't have a confined space. It's the backyard. And if there's 5 units in our building, it's a communal backyard. And then you have another building that's another 5 units. But we have found that renter still wants to have some private space, primarily for the dog is what they're looking at. So we do rental townhomes. And that's just a little tidbit we've learned from that renter demographic.
Got it. And with that, do you guys also then, are you doing the management yourself, or do you outsource the management?
Once upon a time, we did do the management ourselves. And we found that the returns and the margins that you get on the management are so low, it wasn't worth it. We just didn't have the volume to make sense of it. The more units you're managing, the more efficient you can become and the more profitable you become. And so we teamed up with a company that we really like that just manages all of our properties. They manage well over 10,000 units. And we said, you guys do what you're really good at, and we'll do what we're really good at. And it's been a really good change for us. We are not, we're not experts at property management. And if you're managing 10,000 units, it's pretty easy to learn what works and doesn't work and implement it on all of them. Whereas you only have, 4, 5, 600 units, your learning curve's a lot longer, which is a lot more money.
Right, right. So if you were to compare like a 20 unit single family rental development to a comparable 20 unit apartment building or complex, how do they compare numbers wise?
My preference overall would be to take the 20 units of houses for multiples of reasons. Generally speaking, it's a higher quality tenant. Your turnover rate is much lower. How often they're moving, and that's one of the biggest expenses is that turnover. How long is it going to stay empty? Do I have to repaint walls? I've got to shampoo carpets, whatever it is. So your turnover rate's quite a bit lower on the houses. And if you're building them all together, if I've got 20 units that are spread all over, I'd rather have the 20 apartments. But if I've got 20 units, houses that are all together, it's easier to manage. When I've got to show a unit, I can also be there for other things. If we've got to do repairs on the homes. And we find not only is your quality of your tenant better, but because of that, you have less things to deal with. The apartments, they might call you because a light bulb's out. It's like a new bulb in. Whereas the tenant in the house is just going to put a new bulb in. I can change the bulb faster than I can call you and ask you to come over and meet you. And so our preference is the houses, and we believe that houses are more profitable because of all of those other components I just mentioned.
Right. Rental rate comparison, is there a significant difference between and again, give me a size comparison for the units for the like the apartments versus the homes? Are they different bedroom count, bathroom
For
count, square
for us, it's
footage?
a tough comparison because of we aren't doing like kind. Um,
Okay.
so our apartments are primarily workforce housing, very affordable. Just to give you an idea, our apartments rent from 1,000 to $1,400 a month. Most of them are 1 or 2 bedrooms, no garage. Um, Whereas the houses are 3 to 5 bedrooms, 2.5 to 4.5 bath, 2 to 3 car garage, um, brand new. We build the houses and then turn them into rentals. And so it's tough to do a comparison there. And in contrast, our houses, they rent from $2,800 to $4,000 a month. And so there's a big difference. The people looking at our apartments are never going to be looking at our houses and vice versa.
Sure. No, and you mentioned you're kind of a more of a value approach, but that's a pretty significant. What's the square footage on the or range on the single families?
Our smallest would be some townhomes that we have, and those would be at about 1,600 square feet. Those would be a 3 bedroom, 2.5 bath, 2 car garage, about 1,600 square feet. And
And
those,
what's
I think I might have misquoted. I said 2,800. I believe those are actually renting at 2,500 a month.
okay? And the largest that you'd build?
That we build and rent, we cap out at about 2,500 square feet. And if it's got a basement that's finished, you end up being about 5 bedrooms. Not about, you end up being 5 bedrooms and 3.5 bath. And in those homes, in specifically in Minnesota, garages are a big deal. I've lived in California and Nevada and Utah and have experience all over the country. But in Minnesota, people actually use their car to park in
Yeah,
versus Christmas
all their stuff.
decorations.
Yeah,
Yeah. And so,
yeah,
when you get into the bigger homes, 3 car garages are pretty significant because I need my third stall for the Christmas decorations, but I need the first two to park my car in.
right, right. No, I could see that being a very attractive option. And on a rent uh, point, what was the you said on the larger like the 5 bedroom? How much do those rent for?
Those will get up to 4,000 a month. So you're
Okay,
definitely targeting a higher income bracket. Usually that's a family that have a few kids. A lot of times they're working from home, so they want the extra bedrooms to be able to have an office. In many cases, we're seeing this more and more where they need 2 offices. So it's a couple that's living there and they both work from home part time or full time, and they both need to have a separate office. Well, so if we're a couple, one, I need my bedroom, and then we both need an office. That's 3 bedrooms, and we don't have kids or anybody else.
right, right. So okay, so that explains. So part of the bedroom count is for the office. I mean, that's what they end up being used for. Is that
Yep.
from
Yep.
okay?
That's
Okay,
exactly right.
got it. No, I love the home office, bedroom use kind of thing because that is not the wear and tear of six people living in a house like that. Because I've had the small house, lots of people, and that's a little bit more wear and tear than the couple in a big house with a couple offices kind of thing.
Yeah.
So
It's
yeah,
interesting. We're even seeing that in for sale. Just in the last 2 weeks, we've been reevaluating our for sale housing plans. And we have a plan that historically, prior to COVID, was a really good selling plan. It was about 2,300 square feet. It was 4 bedroom, 2.5 bath. Had no, the main floor was a kitchen, dining room, living room space, and a half bath. And that plan, we can't give them away. Nobody wants that plan. We have a plan
really,
that sells for 20,000 more that has, we call it a flex room on the main level. We call it a flex room. So people might use it as a formal living room, a formal dining room, an office. And that plan's selling really well. And what we're learning is people don't want that other plan because they love having a main floor office. And so the one that's popular, most people are turning on main floor, and they don't want the other one because now my office has got to be upstairs or in the basement. And they want often that main floor. And so we're seeing that trend in for sale. And we just recently discontinued that plan, albeit 4 years ago, it's one of our best sellers.
hmm. Well, it's kind of like a reflection of what the market's giving. I mean, or the demand, I guess. That's
Yeah.
interesting to hear that. Um, so we're talking about the single families. What do you see is the advantages or the what makes single family more of a favorable investment right now?
From a rental standpoint,
Well, as an investor, I mean, yeah, yeah, absolutely. As an investor, I mean, obviously, if you're uh, selling them, I would assume you'd want to be either the builder or flipping something that you're finding low and selling. But just as a rental investment,
some of it is, your barrier to entry is much lower. I can go buy 5 houses much easier than I go find an apartment complex. You're just not going to find apartment complexes that are 5 units, generally speaking. And so, the barrier to entry is much, much lower on housing. Uh, one of the things I like about housing is your exit strategy. If I take and I do an entire subdivision of houses, 50 houses, I've got two exit strategies. I can sell all 50 units to you as rentals that are cash flowing in a positive investment, or I can turn around and sell them all individually to 50 different buyers. And so there's more flexibility in that exit strategy. So I like that. I like the stability, of your average renter is much more stable in the for sale housing. So we like that. Now, with that being said, we're still active in the apartment world. But if I'm just getting going, housing's a really great place to start. There's, depending on the market you're in, if you're just looking to start a portfolio, a lot of builders will give you a really big discount if you come in and say, I will buy 2 or 3 or 4 or 5 houses and just do your standard offering. So you can get into it much easier. And then you're buying, if you do something new, the furnace has a warranty on it. Shingles have a warranty on it. If I go buy something that's 30 years old, I might be replacing a furnace tomorrow.
yeah, yeah, yeah. No, I know all about the old homes and capital improvements. Um, and as opposed to a new home, there's no comparison that those capital improvements can eat you up in a hurry, and especially with one tenant, as opposed to if you have multiple tenants, like in an apartment building, you do have some cost effect, or there's some there's a cushion there because if one unit goes down, you're still collecting
Spreading it over
rent.
multiples.
Yeah,
Yeah.
or you have an air conditioner goes out or a furnace or whatever it is. You've still got a revenue stream. When you have one, I mean, the trade-off is that if you have one tenant and they leave and they've been there for a long time, there's usually a fair amount of investment in the turn there. Um, and if you,
We have a perfect example of this just two
yeah,
weeks ago, really a tragedy, a very sad story, but we had a tenant of our house committed suicide in the unit.
mm,
If that's my only rental, that's a big problem for me because, our cost, how long is that unit going to stay vacant? The cost of the hazmat, the cost to replace the carpet, all of that goes in. If I've got one unit, that could be devastating. And so, I
right,
mean, that's something that you've really got to be cautious when you get in is make sure you've got some dry powder for those kinds of instances.
right. Yeah, and I think that I've got a little bit of both in our portfolio, and certainly started out with the single families, and would encourage anybody to do that. But having both, and not having, or let me put it this way, having older homes and having newer homes. If you can get into the newer, there's a cushion there from all the like we've been talking about, all the capital improvements or potential capital improvements. But then also, I think just even if you have multiple rentals, whether it be single families or others, just to have some sort of a cushion on the income to where that, whatever your mortgage or expenses are, you've still got a revenue stream that can cover that as opposed to, going into your savings or you know, whatever your capital was that you're planning to invest in more properties kind of thing. It's just something to keep in mind, but I wouldn't let that keep you from investing just as a matter of something to, keep in mind because it's a reality.
Yeah.
It's not every day. It's a possibility. Um, but I think also the thing that I like what I heard you say is about using third party management. I mean, I managed my own for years, and inevitably became, friends with some of the tenants. And next thing I know, they're making up the rules, and it's like, you get your rent when they decide to pay, kind of thing, as opposed to, it's due on the first or you're late, and the process starts with management that has a, kind of the crack in the whip kind of thing, and enforcing the rules. I mean, not even cracking the
Yeah.
whip, just enforcing the rules. There's a little bit more of a sense of urgency about paying rent, um,
Yeah.
type thing. So that works out well. Um, so let me ask you, as you look at the market, you've been doing this since 2011. Clearly, we're in an entirely different market today than we were then. Interest rates, inflation, post-COVID. Um, what do you see is the, you know, has the demand for product changed? You talked a little bit about the floor plan changing. What about like the size of property, or do you foresee this trend to the single family rental continuing and becoming more and more of a thing? And I
I
guess
think it's,
there's a couple things. And also I just want to ask you in that, just also talk about how the interest rates are affecting, the
yeah,
marketplace here.
I,
So,
I think it really comes down, the focus is value. You look at the interest rates, we've got millions and millions of people that are in homes that are interest rates plus or minus 3%. Well, today at this recording, we're plus or minus 7%. And that's huge. So all of a sudden, I used to be able to afford a $600,000 house. Now I can only afford $400,000. And the ultimate amenity is value, is cost. So what we're seeing used to go into homes, whether it's a rental or for sale, we're basically getting it simpler. We're not putting as fancy of amenities in, as costly amenities, because people would rather today have a little more square footage than a little fancier, with the idea of, well, I can eventually put that fancy backsplash in, or I can eventually do whatever it is that they're dreaming of. And so um, efficient, cost-effective units is what we're seeing is the biggest draw right now, because people just, they can't afford what they used to be able to. And we're seeing that true, whether it's on the for sale or the rental side. We are right now, we don't have any active deals on new deals for apartments. There's going to be some real opportunities coming. We see that coming, but we're not seeing much of it today. And that's really driven by interest rates. If I've got apartment complexes that I've got, Freddie Mac small cap loans on that are sub 3%. Well, if I build something next door, one, my cost of labor and commodities are significantly higher than they were a few years ago. We're 5.21% inflation each year for the last 3 years on average. So the cost to build that unit is significantly more. My interest rates are significantly more. So a unit that I might be renting today for 1,500, I might have to get $2,500. And we're just not going to draw them. And so a lot of those renters are consolidating households. They're staying with mom and dad longer, they're staying with friends longer than they would have otherwise. But we are seeing the people that want houses, they're still going out and looking to rent a house, or they're still going out to buy a house. So we're seeing a lot of positive growth continuing there. Uh, with that being said, we're working on apartment deals that we're looking at closely, that we want to get going, because we're a year or two out, that all of a sudden there's not going to be a choice. People have to move somewhere, and there's nowhere to move. And so we see the opportunity coming. It's just not quite here yet.
got it. So, and as the kind of the market changes, and I think what's interesting, what I heard you talk about was I was assuming, or I was thinking that maybe the square footage would have been one of the changes, but you're saying that the square footage is still kind of the primary. It's more of the level of trim that the people are willing to take a lower level of trim, recognizing that if they choose later on, they could, change out and upgrade. And is
And
that,
that's a really interesting question, because I've been through enough of these cycles, the early 90s, the early 2000s. Um, that was the driver. It would be square footage. But with COVID having happened, what we saw shifted is people still want the square footage because they're working from home. So instead of giving up square footage and keeping the amenities, we're seeing a little bit of a different trend this time of I still need the square footage because I still need to have a home office. But in order to have that, I've got to give up some of the amenities that I would have had. And so it's a little bit unique through this cycle.
Yeah. No, I just in my little brain there, I was thinking that the solution would be a lot of the kind of the traditional smaller homes and stuff. But like you said, that whole work from home thing kind of changes that. You still need the bigger footprint.
Yeah.
Yeah. So tell me, your company, Centra, um, do you guys build for yourself? Do you guys attract investors? Do you raise capital? How do you operate there?
So Centric Companies, we just started Centric Capital Partners this year. Everything we've done historically, we've either brought in an individual investor or we're self-funded on everything that we've done. This year, we started Centric Capital Partners to where we're allowing people to co-invest with us. And so any deals that we're doing, we'll put on the platform. So right now we have two for sale housing projects, one that's 39 units, one that's 107 units, where people in effect could be a part owner of that project and co-invest to build wealth with us. Um, and right now we don't have any offerings currently, but we will have some that are built for rent, the single family communities and some apartments. And the idea with that is it started actually 3 years ago. One of the benefits we provide our employees is they can buy houses at cost. And I've got one employee that takes advantage of that regularly and has built up a pretty sizable portfolio of rental houses that he's built great wealth. The unfortunate thing is the way the tax code is written, I'm incentivized to invest in real estate as a real estate professional. Because he's a W-2 employee, he doesn't have that same incentive. And that really bothered me. It's like, okay, I own my own business, so I'm accelerating my wealth, but I'm also magnifying that seller acceleration because of the tax code, and he doesn't have that same advantage. And that's actually how Centric Capital Partners came about. That bothers me, and I want to fix it. I want all of my people to be able to get wealthy right with us. And that's where it all started. And eventually it evolved into, well, why don't we just open this up to anybody that would like to? Let's do this for employees. Let's open up to friends and family. Why don't we just open it to anybody that wants to build wealth and be in real estate, but they don't want to deal with the cockroaches or the broken down furnace? They can just co-invest with us and build wealth right along. So we're really excited about that. We just launched that this year, and we've had some good success so far.
So it's a fund then? Is that the way it works, or?
Yeah, we're doing it a little bit different. In that, typically a fund will be, we're going to raise $30 million and we're going to invest it in a lot of different projects. Whereas we're doing it project specific. So we've got a project that we're raising $2.5 million. So you can invest $100,000. Somebody else can invest $1 million. But you're now part of that specific project. You're going to get a return on that project. And once that project runs a course, you'll get your money back. And then you can go invest it somewhere else, or you can go invest it in the next project with us. And certainly
Got
there's
it.
somebody out doing this, but I don't know of anybody in the nation that, one, is allowing people to co-invest on for sale housing, and two, doing it on a per project basis versus a fund. We thought that would be a pretty interesting offering, and so far it's proving to work.
Got it. So on a project, whatever your 20 plus homes or whatever, is that kind of that would be the what the project is, and then as you build those and sell those, or are you putting those into a rental model, or I guess you could do whatever you wanted to and have a
These two
mix.
particular ones are for sale. And so
Okay.
we've got a project, it's 39 lots. We already own it. We're already developing it. Somebody can co-invest in that. We did a phase one, and so it's already a proven model. Now we're doing phase two. And so it's got to be somebody that's got patient money, because it's not like buying an apartment and you're hoping to get dividends next month from rents, because we got to develop it. We got to develop the lots. We got to build the homes. We got to sell the homes. We got to close them. And so if somebody invests today, they're not going to start seeing returns on their money until spring of 25. And then they'll see all of their return in about a 2-year period. But with that patient money, they're also getting really great returns. The ROI on that money is about a 20 to 24 month, and they're getting about a 32% ROI. So we feel like that's a pretty lucrative return. You annualize that, you're a little over 15%. Um, and but it's got to be somebody that's got patient money, or IRAs are patient money. We just teamed up with Equity Trust, a national company. They manage about 45 billion in IRAs that people can also invest their IRA into it. And I was looking at my dad's IRA. He said, "Hey, take a look. I want to invest." I'm like, "Yeah, you're my dad. You probably shouldn't." He says, "Well, look at it."
Yeah.
And I looked at it. I'm like, "Dad, you're losing money. You're getting, by the time you pay fees and everything, you're less than 5.21%. That's inflation. You're going backwards." So
Yeah.
I conceded, and he invested all of his IRA in one of our deals.
I was going to ask you about that. So when the IRA money gets in there, are you guys leveraging the projects then? Or is that the money you're raising, is that your basically a down payment, or are you going
Yeah,
project
we
to
do. So
project, or I don't know?
we go get institutional debt.
Yeah.
Typically, it's at about a 65 to 70% loan to value. And then the equity capital we raise is making up that other 30 to 35%. And so typically we use regional banks that provide the debt. It's
Yeah.
We did look at that. If we raise 100% private equity for the entire project, now all of a sudden, instead of the project I was just talking about, its IRR is 17.9. Well, that 17.9 all of a sudden goes down to 8 or 9. Whereas if we leverage it, we can give you a much better return.
Right. Right. No, makes sense. So the projects are you guys are the as far as the building, or do you have subcontractors, or do you have employees that are doing all the construction, or how are you set up that way?
Yeah, we're the general contractor. As I like
Yeah.
to tell our team, if you use a tool other than a pencil, we paid somebody twice. So we
Right.
subcontract everything out, and we just provide the purchasing team who identifies the contractors we're going to use, qualifies them, and then the management team that's out on the site, making sure people do it right, making sure they show up on time, get finished on time. And so we're really an administrative role as the general contractor.
Got it. What are your views, or what do you see, or how do you see the market playing out here next 5, 10 years?
I've never claimed to be smart enough to figure that out. I'm a huge believer there's opportunities always. And just be watching. You'll find what you're looking for. And if you're looking for opportunities, you're going to find opportunities.
Well
And
said.
I could have never predicted COVID. I could have never predicted when 9/11 happened and the economy shut down for a period of time. I could have never predicted what happened in '08 would happen to the extent it did. The prediction that would happen, absolutely, but to the extent, no way. And so for me, it's just look for opportunities and be cautious in how you underwrite those, and just keep going.
Yeah. No, well said. Hey, Dale, if we could, I'd like to shift gears here for a second. As I mentioned to you earlier, by day, I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. If that's not an option, we look to see if we can minimize the risk. And if we cannot avoid nor minimize, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, the Fed, political, whatever it is that you identify as the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Dale Wills, what is the biggest risk?
I think there's two parts to this. One, on the insurance side, is I'm a huge believer in surrounding yourself by the best people. And insurance is huge risk. I'll use an example. In the Midwest, it's almost impossible to get mold coverage. So if I build a house, mold grows, I've got no insurance coverage. Now I can get a rider, but if I don't have an insurance agent that's a pro that really knows their stuff, I've got massive exposure, because mold risk is one of the biggest risks in the Midwest. And so if you don't have somebody that knows their stuff, you almost might as well not even have an insurance policy. So I don't want to disparage agents, but the guy you buy your auto insurance from and your homeowner's insurance is not your guy when you start having rentals, or you're in big trouble. So that's one thought I had. From a risk standpoint, I think the biggest risk is what you don't know. What do you not know? And that's where I think it's important you have experts around you, because even then you can get in trouble. Where we've done projects and we thought we knew everything, and we tested the soils and we tested the ground, and we had the best of the best experts, and we started digging and we find 5 feet under the ground, there was an old abandoned gas station that we should have known about. Well, that's a pretty big risk. And so that's what I worry about. I have a friend, Keith Cunningham, teaches a principle. When you look at any deal, identify what's the best that can happen. And, that's really easy for entrepreneurs to do. We always can see the best that can happen. So we have this long list. What's the best? Then what's the worst that can happen? And then we look at that. If there's not a long list of the worst that can happen, we don't do the deal, because there's always a negative to every deal you do. There's always a drawback. And if we're not seeing it, we're missing something. So we need to go back and look, what are we missing? Once we've done that, we say, is the worst case scenario, can I live with that in order to get the best case scenario? And if I can't live with the worst case scenario, we pass on that deal. But that still doesn't answer what you don't know is your biggest risk. For us, that's our biggest risk is the unknowns. And some of it's unknowns you can't predict. We talked about the COVID. You can't predict that, but you better be ready to be able to shift pretty quickly.
Yeah, definitely the what you don't know kind of thing. But I like your approach on considering not just all the good things, but clearly the bad things. I think there's clearly a fair number that are getting caught in the negative aspects of just how the interest rates are affecting their deals and that. And I'm assuming rosy colored glasses kind of got in the way of looking at the potential of a negative rate affecting the outcome of their deal. So, but I think one of the things that's sad is I think that we're, as humans, I think more often than not, we tend to forget the bad things, or not. It seems like, oh, that'll never happen again, kind of thing.
Yeah, sometimes
beware.
Entrepreneurs are the eternal optimists.
Yeah. Well, and you have to be. There's got to be some sort of you got to look at it as the possibility as opposed to, you're scared to leave your house in the day, or,
Yeah.
So there is a balance, but I like the kind of the group approach, having multiple minds kind of think through it and look for the ups and the downs, and then trying to, discuss through it and trying to, just kind of measure the risk and determine what is, what's a risk you're willing to take, as opposed to, not even considering what the risks are. So that's good. Dale, where can the listeners go if they'd like to learn more or connect with you?
You want to connect with me? LinkedIn is a great place. Dale R. Wills on LinkedIn with Centra Companies. Love being on LinkedIn and making new friends there. And then CentraCapitalPartners.com, Centra with a C, partners.com is a great place to just see projects we're involved in, investment opportunities, different things that we're doing.
Awesome. Well, Dale Wills, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thanks for having me.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.